Aloha, and welcome to the Sylvan Bell Business Growth and Exit Strategy Podcast, your guide to building companies that command maximum multiples. I'm Sylvan Bell, author of 5 books on business strategy and sales, creator of the Sell Framework, Scale Framework, and Driver Test. I work with owners of $10 million to $250 million companies, whether you're scaling for growth or positioning for a profitable exit. Each episode breaks down one framework, strategy, or concept you can apply this week to grow revenue systematically, scale operations, and maximize enterprise value. Let's get started. Welcome to episode number 37, the exit framework, reading the 3 timing signals built into the exit ratio 360 system. Whether you're shooting for the maximum multiple or working on getting the most profitability out of your company, this can help you out. Exit stands for economic climate, exit multiples, industry momentum, transition readiness, and buyer demand. What you need to know is you can build a business worth $30 million and still sell it for $18 million. Not because anything was wrong with the company, but because you read 2 of the 3 timing signals wrong and missed the one that mattered the most. And that hurts. You don't have to do that. Buyers, the people who want to purchase your company in whatever way that happens, they have timing windows. They have capital they have to deploy on schedule, investment dates with expirations, portfolio strategies, and the shift that they have to make with market conditions, taxes. Sometimes it even comes down to politics. And they come in and they say, hey, we're actively acquiring in this space, in this market for the next 12 to 18 months. And after that, our thesis moves. They're investing, the way that they're going to invest is going to change. And if your business isn't ready during that window, they're not going to wait. They're going to go find a competitor. They're going to go move to a different area. They're going to go prove their thesis by finding the company that plugs the hole that they're looking for, that Excel Eddie has figured out. You know, it may be that they buy your competitor down the street, the dude or the chick that's prepared and ready to go, or that decides that it's the perfect time, and you know, they weren't sitting on their hands saying, I'm thinking. If the market's cold and the buyer capital is sitting on the sidelines, the best business in the world trades at discounts because there's nobody competing for it. You want the competition. You want people to bid against each other to buy your company. And this is not an absolute, but most buyers don't adjust to your timing. You have to adjust to theirs, and you pay the difference. I'm going to tell you a real world experience that I'm going through right now. I pulled the plug on a deal that I've been working on for 18 months because the buyer, in my mind, was playing games. The buyer in the market that they were in just wouldn't commit. And I had to take a look and say, there's other deals on the market. It lost my attention. And you know, here's the thing about deals, and you know this. You've seen enough excuses in your life. You probably grew up as into sales before you had your business. You've had to do sales in your business, and you've seen people delay. Like that's whatever reason they're dilly-dallying, they're not making a decision, and you know it. I'm going to share with you, account executive who's the one who's going to work with you on the deal, and your vice president of sales who's going to work the deal for you. They've seen all of these patterns before. They're going to leave lunch and be like, yeah, they're not ready. They're going to leave the Zoom call or the phone call and go, nope, they're not on board yet. They've lost our attention. And you have to know that like they're grading, like when is our opportunity, and we have a launch window that we have to fulfill within. And if your company's not ready, we're just going to walk away. And then what you have to put up with sometimes is the multiple changes. You could today, right now, be at an 8 multiple for your company on EBITDA, which would be fantastic. And then 6 months from now, the market changes and they're going to come back and change your offer. That's why letters of intent have time on them. Like most letters of intent could be 7 days, 14 days, 28 days, whatever number that the attorneys put on there. But the reason that they have an expiration date is because the market changes, and sometimes it's a test to see if you're on board to do the deal or not. When you do the math, exit carries 40 points in the exit ratio 360, and it measures whether the signals are aligned or not. Is your market active? Is your business ready to go? And are you? Are you ready to go? There's a couple different ways to look at this. It could be the operator who spent 3 years perfecting the business but launched into a down market. The owner caught a hot market and hadn't addressed client concentration. The founder who had a ready business in a strong market but couldn't emotionally hand over the keys. Let's just give you Chuck. Chuck couldn't let go, and by the time that Chuck was ready, the window had closed. Here's your diagnostic that you may want to take and score each one of these independently right now. Is M&A active in your market, in your product, in your service? Is your exit ratio 360 composite where it needs to be? And could you personally sign the closing documents in 90 days and walk away without looking back? And if any of those three are a no, your exit score is not just telling you something, it's screaming something. Something's going on to cause you to not be prepared and not be ready to not exit. You may say, hey, Scott, where do problems hide? How do I know? Well, the first hiding place is in market timing ignorance. Most mid-market owners, they don't pay attention to what's going on with M&A, and they don't know where the industry sits in the cycle. Your industry could be hot right now and cold in 2 years. They don't track comparable transactions, average multiples, or buyer activity in the sector. I'm going to encourage you to start tracking this. And one of the things is, don't track this at the office. Track this at home. Like some of the things that we talk about really shouldn't be looked at the office. I'm going to let you know I've been in enough offices that as people come into your office, they're looking at your desk, they're looking for clues, they're looking for information. As people are working on projects, sitting at your desk, sitting and talking to you, they're profiling too. Hey, what's going on? Like, I read very fast. I can scan and look on tables. I can scan and look on paperwork, and I can get the gist of something really quick. I'm not saying everybody's like me, but if they're going into an office, they're like, hey, what's going on? What are they reading? What are they doing? These are all things that you need to be aware of. And sometimes the content, the books, the podcasts that you listen to are really meant for you to listen to them, not in the office. One of the mistakes is to just think that everything's on your schedule and that the market's going to bend towards you. Sometimes deals close within 6 months and that's it. The market, hey, the multiple was hot because it was first in. Last out sometimes gets the worst deal because they're the last in the marketplace, especially if the platform companies are all being bought up and then like all the private equity comes in and says all the platform companies are bought. You get tuck-in numbers. Platform numbers are at the top because they're going to bring companies and put them underneath you. Tuck-in companies are going to be smaller because, well, they're not platform companies. The A companies, the A+ companies get the biggest multiple. The B companies, they do okay. The C companies, the tuck-ins, those are the stragglers. Those are like, hey, we kind of found a deal. They're going to go in. They got some money. They're okay with the exit. There's got to be a point in your identity where you say, I'm good with moving on. Right? This is a real conversation. And sometimes it's going to come down to you talking to a professional. Sometimes it's going to be one of those things where you have to meet with somebody and say, I don't know if I'm ready or not. And it could be with your significant others. If it's going to be with management team, you should have them sign a non-disclosure agreement, talk to an attorney. I was going to say, I'm not a doctor, attorney, marriage counselor, or therapist. Talk to an attorney. But the timing really does matter. And you really do want to pay attention to what's going on because you want to get the maximum multiple. You want to win. And if you're paying attention to these factors and you're charting them outside of the office, you know what's going on, but the team doesn't. And there's no clue to them. There's no signal to them. For the buyers, timing misalignment shows up. You know, when a buyer is actively acquiring and the owner can't get transaction speed for the financials or answer questions or make decisions without weeks of deliberation, the buyer reads that as like, okay, they're not ready. We're going to move on. They watch for founder and owner behavior early on in meetings, and hesitations start becoming timeline questions, conditions that keep expanding. Well, you know, I want to stay involved, and then a whole bunch of growing lists, and then wants to renegotiate all the time, and then ends up with a whole bunch of LOIs that they can't sign, and they keep missing dates. At some point, Excel Eddie says, hey, window of opportunity is closed. I'm sorry. We're going to move on. You had the opportunity. We can't do this anymore. Like I shared with you earlier in this episode, I had a deal that yesterday I pulled the plug on. Not doing it. And I've got a partner in that deal, and I literally told him, I said, I'm out. The person that we're dealing with isn't prepared. We've been going for 18 months. It's lost my attention. It was beautiful, and I wanted it. I wanted this deal for a lot of reasons. But then I started looking in the market. There's other opportunities with less drama. And like, I'm giving you real how people think. Like if you were going to acquire a company and somebody dragged their feet, we're going to kind of do it. We're maybe going to do it. And then all of a sudden they're like, okay, well, now I don't know. At some point I got to go, they got to go, you got to go, hey, this isn't a real deal. You're not a motivated seller. You really don't want out. And you've been on sales calls. If you're an owner, if you're a founder, you've met with this person before. You know this feel. Like you're probably feeling it right now and you're like, oh my goodness, I've had that happen. You don't want to be on the downside of that when you're dealing with an account executive or with private equity or a private investor. Right? I'm literally telling you, less than 30 hours ago, I had this conversation. I'm out. I don't want to deal with this. Because like now I got questions. On my end, what else is hiding? Does the founder think like, okay, I'm probably going to get more money? Well, at the end of the day, things have changed. The founder is going to end up with less money. But for them, I'm out. I've made the decision. I'm not into the deal anymore. I'm moving on. There's somebody else that's got less drama. And with less drama means that I don't have to worry about, hey, what else is going to go wrong after the deal is done? This is the thing that I talked to my partner about. I said, hey, listen, for this deal in this place, in this location, I don't want the drama. I'm going to share with you right now, for the way that this deal is going, it's drama. And my partner, he's like, I really want to do this deal. And I said, I really wanted it too. It's been 18 months though. You know, I really don't want to play these games anymore. And if these are the games that we're playing before purchase, what are the games during the purchase? And what are the games after the purchase? I'm out. Like I used my signature phrase and we kind of chuckled about it. I said, peace out, Girl Scout, I'm done. And I said, you can tell the founder that that's what I said. You can literally put that in the phone call, the email, the text message, whatever way that you're going to do it, but Scott's out. I hope this founder has a good life because I really don't want to deal with them again. It's on them. And they lost out. Like I had plans. I had things lined up for this company in the location that it's in. It was a market that I really wanted to work within. I'll find another company in that market or close to it within 100 miles and I'll be okay. But I won't have to put up with the drama that the founder was giving. So like when you're saying, hey, do buyers detect it? Yeah, I'm literally laying it out for you. There's a thing that I refer to as valuation penalties. There's other people who call it that too. And it's timing misalignment. And it's one of the most expensive invisible items that's on your list that cost mid-market companies money. And it doesn't show up as a line item. It's the window of opportunity. And it could be the difference between a 6 multiple, an 8 multiple, a 10 multiple, whatever your industry, product, or service trades at. And that could be a couple of years of retirement. It could be the difference of you vacationing on the beach or owning a house on the beach. And that's just because timing has changed. The market's changed. You know, the market was hot and it was what everybody was into, and now they're not. So I'm going to share with you that private equity is typically lazy and they run to what everybody else is doing. And then when they've harvested enough companies, they're like, okay, we've had enough. They go for the next one. And then they're like, okay, well, we've got enough. And then they go for the next one. Or the industry or the company that was going to come in, or the private equity, proved their thesis, right? So most private equity runs on a 5 or a 7 year purchase program. And at the end of 5 or 7 years, if they prove their thesis, then they either take it to a bigger private equity company or they take it to go to IPO. Like that's the plan. Like buy a whole bunch of these companies, prove that there's a bunch of EBITDA, stack that EBITDA. And now that the EBITDA is there, they're like, look at how valuable this company is. In the in-home service space, a company like 2 weeks ago literally just sold for $2.5 billion because this is what they did. They rolled up all the big players in the in-home service space for this industry on the West Coast. All of them. All the big boys got rolled up at once. And this was 7 years ago. They proved the thesis. They proved profitability. They proved the numbers. And a huge private equity company came in and paid $2.5 billion for them. Like that's the game. Take companies from, $2 million in EBITDA to $200 million in EBITDA, and they get a 10 to a 15 times multiple. And that's going to happen over 5 to 7 years. And it's like sometimes if you're at the tail end, but you're in an area that hadn't been processed yet, you want the best opportunity. This is why I'm a huge fan, and I talk about the 5, 4, 3, 2, right? You can absolutely prep a company to sell in 2 years. The best opportunity is to prep a company in 2 years and find your 3-year window. Because sometimes just the timing's not right. Initiatives fail, projects fail. The economy might move. You might have a tough time for 1 or 2 quarters. But if you have 5 years of history, you've got 20 quarters of history. It's completely different than 8 quarters of history. And if you're tracking and saying, hey, consistently year over year, quarter after quarter, except for 1 or 2 of them, we had up quarters, that history is valuable to you on your exit. And message from your sponsor, Sylvan Bell. That's me. If you're getting value from this episode, here's how to go deeper. First, subscribe to my weekly newsletter, The Party, at scottsylvanbell.com. That's where I share the strategies, frameworks, and case studies I don't release anywhere else. You'll get one actionable insight every week you can implement inside your business immediately. Second, while you're on the site, download the complete Sell Framework, Scale Framework, and Drivers Test, all free with scoring guides, worksheets, and step-by-step implementation checklist. These are the same frameworks I use with $10 million to $250 million companies to build systematic revenue, scale operations, and maximize enterprise value. Go to scottsylvanbell.com right now, subscribe to the newsletter, grab the frameworks, and let's keep building companies that command maximum multiples. Let's get going. There's a secondary consequence when it comes to all of this money and buying a company and an organization is you may miss a market cycle. And you may end up saying, well, now we got to wait 2 or 4 years. Once again, we're going to go back to the 5, 4, 3, 2. If you say, hey, I'm going to prepare my company to exit in 2 years, but I'm going to decide when I want to sell it in those last 3 to my advantage, when I want to exit. That's the best opportunity for you. Because you front load the first 2 years, you get everything done, and then you pick the window of opportunity that works best for you. And then that way, if you have some dings, they're not always dents. And then sometimes when you have dents, you can take them to dings. And peak readiness on your end is one of the greatest benefits that you can have. There's a ripple effect. Let's say that you're in a market. I live in Sacramento, okay? Let's say that your industry, your service is based out of Sacramento. Just pretend here for a minute. Let's do this for pretend. And you have 3 major competitors. And one of them gets sold to private equity, gets sold to a buyer's group with deeper pockets than you. And now they have the money to market. And now they have the money to acquire higher, better, greater talent. And now they have the ability to come after your clients because they've got more money to spend, they got more talent, or they start trying to harvest your team. Like, you're missing out on opportunity because you waited too long. Sure, there's all the legal things that you can do and try to put into place. There's conversations you can have. But if they come in and they beat you with technology and you can't match it, or they buy up a couple of the other competitors around you and they create a tuck-in situation. So they buy a platform company and they buy the A company in your area, and then they tuck in a couple of B and C. Now they've got mass. Now they've got momentum. Now that they have something that's going to take you higher energy and effort to compete against. You don't want to be downstream on the bad end of funding. You want to get the maximum multiple while you can. You want to have as much exit strategy in place and in time. So there's 3 fixes for you. You want to build an intelligence system with the dashboards, market timing. You want to track transaction in your industry at least quarterly. Deal volume, average multiples, buyer activity levels, capital deployment trends. And whoever your M&A advisor is, your industry association should be tracked as well. You got business readiness. What's your exit ratio 360 composite score? Track quarterly. What's your target threshold? What are you looking for? What's your personal readiness? Like an honest self-assessment. Like, do I really want out? Every founder, every owner, every person I talk to, they oscillate. And oscillate is this: I want to do it, I don't want to do it. I want to do it, and I don't want to do it. And it's usually an event in life that usually just says, I'm out. It's a birthday. It's 30, it's a 40, 45, 50, 55, 60. It's somebody retiring that you know. It's a life event where somebody dies or has a heart attack. We're just going to say what it is. Or you just get tired of the shenanigans inside of the office. Those are like the 4 major reasons. And then, do you have financial readiness? Do you have a tax CPA? Right? So you have your seller thesis. You also have a tax thesis. And this is one of the things that is the hardest to find. I'm going to let you know from dealing with this, like there's accountants and there's CPAs. And then above an accountant and a CPA is a tax CPA. This means that they've got multiple degrees. They've got a a JD. They've got a JD in law, a Juris Doctorate. That's what my brain was trying to figure out. A Juris Doctorate in law and a CPA license. And I'm going to let you know, because you're taking a top-notch person, you're going to pay them double of what you normally pay a really good CPA. So you're going to want to budget something like $750 to $1,000 an hour. If you're in a big market, it could be a little bit more. But like it could be the difference of $1 million, $2 million, $3 million, $5 million in taxes for you. I am not a tax dude. Like, I'm not the tax guy. Don't ask me for tax advice. But like when you're talking about fixing what's going on, the person that you want to find that is, I'm going to let you know, the hardest is going to be a tax CPA. Like that conversation needs to really start happening like 3 years before a sell. And you got to find somebody you're comfortable with, because there's different levels of tax CPAs. There's the people who are like, I'm scared of the IRS. And then you've got the people who are like, the IRS has rules and our job is to live up to those rules and live up to those expectations and nothing else. That's the hardest. I'm going to share with you. It is the hardest person to find out of all of this. Fix number 2 on this: bring in an M&A advisor early. Start the conversation early, preferably 24 months in advance. For me, I like 5 years. Does it have to be 5? No, but it gives you the most opportunity. This is why I talk about the 5-4-3-2. 24 months in advance or before, because they read market cycles. This is what they do. This is what they're used to. They're used to figuring out who the main players are in the area. They're used to what happens and how to prepare you and the conversations you need to have to keep you in the game. Right? When you're going through due diligence and you're being asked literally 500 questions, like there's a point where you're like, do you really need to know all of this? And a good person on the M&A side is going to be like, this is normal. This you're dealing with Excel Eddie. You're dealing with Excel Edwina. This is normal. They ask for all this documentation for a reason. You're like, you're right on track. This is not strange. This is not unusual. And at the end of the day, you really do got to be ready. Because if you're not, you could drag your feet and you can miss out on the maximum multiple. You want to document your exit timeline with your signals mapped, market conditions. What are the market conditions like for the next 24 to 36 months? Your business readiness. What's your exit ratio 360 composite score? And then the quarterly improvement plan to close the gap. And then your personal readiness. What's your financial model? What's your post-life like? What's your transition plan? Your post-identity plan? And is your documented information transferable? You want to go from, hey, I think the timing's right, to I'm certain of this is what I'm going to do. And almost every owner that I've talked to says, I wish I would have prepared sooner because I feel like I left something on the table. You want as much advantage as you can. You want your seller thesis to be better than everybody else's. So ask yourself, on a scale of 1 to 10, are you ready personally? Is this something that you want to do? And if it's like not a 9 or a 10, start asking why. What needs to be achieved for you to get to a 9 or a 10? We're going to use this like a sales process. Is your team ready? Is the market timing right? And if you're saying yes, yes, and yes, find somebody who can help you with the exit. Find somebody who can help you plan. It's something that I do. Are there other good people? Yeah, there's other good people who do it. It doesn't have to be me. I'm going to let you know that when you look for a professional, there's going to be an investment. And that investment is there to help you be coached through the process. So go through a self-test. How many companies in the comparable business sold in the last 12 months? And were the multiples trending up? Were they flat? Were they down? And if you don't know, you don't have the market signals that you do, you're flying blind. What's your exit ratio 360? Is it above 250? Is it above 270? Is it closer to 300? And if not, why? What's the challenge? What's the issue? And if a buyer put a strong offer in front of you right now, could you do it in 90 days? Could you walk free and clear and say, I'm out? Could you give it the peace out, Girl Scout, I'm done? Because these things matter. This week, build out your dashboard, figure out where you're at, do it offsite. I'm just going to let you know, don't do this at your office. Do this in your home office. Do this on your personal time. Think about these things on your personal time, because you don't want to signal to your team that something's up. You don't want the search history in the office to show that you were searching exit multiples. You don't want there to be books on your desk that talk about exit. You don't want there to be articles that are floating around the office. You don't want people to think what's going on. So for me, people say, hey, Scott, well, you do exit. Yeah, but I also do growth. So some people say, well, if somebody Googles your name, Scott, and they see that you're in our office, that you're talking to us, what are they going to think? Like, I do scaling, and by chance, I also do exit. They go hand in hand. Does it mean that one's happening because I'm having the conversation? No. That would be crazy. That's why all of my content says scaling and exit, is for this very reason. If it only said exit and somebody Googled my name, it would signal the team. But if I have a conversation with an employee, they're like, who's this Scott Sylvan Bell guy? They're going to look it up. Oh, Scott was a corporate sales trainer. Scott does, strategy to do business growth. Oh, and by the way, he also does exit. So if they ever ask, they're like, hey, are we going to sell? Like, no, we're here to grow the business. But what you need to know is, on both sides of the coin, it's the same effort that you're going to put in to scale the business and prepare it as it is going to be to exit. And if you could do both hand in hand, it just gives you the perfect window for your launch, for you to exit your business and have your exit ratio 360 as high as possible. Mahalo for listening to the Scott Sylvan Bell Business Growth and Exit Strategy podcast. Here's what's available to you right now. First, subscribe to this podcast so you get every framework we release. Second, visit scottsylvanbell.com to access the Sell Framework, Scale Framework, and Driver Test. All free with complete scoring guides and implementation worksheets. Third, subscribe to my weekly newsletter, The Party, where I break down strategies and frameworks you won't find anywhere else, with one actionable insight every week. Go to scottsylvanbell.com and enter your email. And if this episode added value, share it with another business owner building a $10 million to $250 million company. Until next time, keep building companies that command maximum multiples. Aloha.